80% of retail forex traders lose money. The math, not the market, kills them. Here's why.
75 to 85%. That's the share of retail forex traders who lose money at EU and UK brokers. It's not a marketing number. It's not a YouTube number. It's the figure the regulators force brokers to publish on their own homepages, and it's been stable for a decade. So before we talk about strategies or platforms or which broker has the tightest spreads, you need to understand what game you're actually walking into. Forex is the largest financial market on the planet. About $7.5 trillion changes hands every day. But here's the thing most beginners miss. Almost all of that is bank to bank. Algorithms talking to algorithms. You, the retail trader, are a tiny rounding error showing up at the door of a casino where the house has been counting cards for 30 years. And worse, when you trade Forex as a retail client outside the US, you're not actually buying euros. You're holding a CFD, a contract with your broker that pays out based on how euro-US dollar moves. Your counterparty isn't the market, it's often the broker itself. That changes everything about how you should think about cost, risk, and discipline. Let's start with the one that kills most accounts: position sizing. Here's the trap. A broker offers you 30-to-1 leverage. You have 2,000 euros. You see a setup on euro-USD and you open one lot because the margin is there. That's a 100,000 euro position on a 2,000 euro account. A 30-pip move against you wipes out 15% of your account. 10 losses in a row, and 10 losses in a row happen, and you're done. Gone. The fix is simple, and almost nobody does it. You risk 1% per trade, maximum. Not 2, not 5 on high conviction setups. 1. On a 2,000 euro account, that's 20 euros at risk. You decide where your stop goes first, say 30 pips away. Then you back into the position size. 20 euros divided by 30 pips times the pip value. That gets you roughly 0.7 mini lots. Not one standard, not whatever the margin allows. 0.7. That's the difference between surviving 10 losses at minus 10% versus blowing the account to 0. Position size, not margin. Margin tells you what the broker will let you do. Position size tells you what you should do. Burn that into your screen. Which brings us to pair selection. Beginners want to trade gold because it moves. They want GBP JPY because the volatility is exciting. This is exactly backwards. Volatility isn't opportunity for a beginner. It's the thing that punishes your bad sizing twice as fast. Start with euro-USD, only euro-USD, for at least 6 months. Here's why. The spread on a raw account is 0 to 0.3 pips, the tightest in the entire retail market. Liquidity is so deep that even during news releases, the spread stays civilized. Gap risk is minimal. Majors rarely gap more than 30 to 50 pips, where gold can gap 200. And every analyst on earth covers it. So when you need to understand why price moved, the explanation is one search away. Skip the exotics. US.TRY, US.ZAR, spreads of 20 to 50 pips. The economics are stacked against you before you even click buy. Skip crypto CFDs. Wider spreads, weekend gaps, no liquidity floor. Skip gold until year 2. Okay, pairs sorted. Now the part where most beginners go wrong before they even fund an account, the demo trap. Every broker pushes you onto a demo account. Practice first, they say. And demo is genuinely useful. For about 2 to 4 weeks, you learn the platform, you place pending orders, you set stops, you figure out which button does what at 3 in the morning when you're tired. That's the value. But here's what demo cannot teach you. The feeling of watching real money tick against you. The pull to move your stop just a little so the trade has more room. The voice that says, double the size on the next one, you're due. Demo P&L doesn't feel real because it isn't real. That's why traders who are consistently profitable on demos so often blow up in their first live week. The strategy didn't change. The trader did. The moment money got involved. So the right path is this: 2 to 4 weeks on demo learning mechanics, then open a live account with the smallest meaningful capital, 200 to 500 euros. Trade micro lots. The stakes are low enough that you won't end your career, but the emotions are real enough to be informative. That's the bridge. Which leads us to the timeline, and this is where most people quit. Months 1 and 2, demo, 50 simulated trades minimum. Months 3 and 4, live micro lots. The goal is not profit, the goal is survival. Months 5 and 6, you start tracking expectancy over 100 trades. Win rate plus average win versus average loss. If you've got positive expectancy after 100 trades with discipline intact, then, and only then, do you cautiously scale. Year 2, same strategy, larger size. Resist the urge to add pairs, resist the urge to add systems. Year 3 and beyond, consistent profitability becomes plausible. Most retail traders quit long before they get here. That's the actual reason 80% lose. Not bad strategies, just bad timelines. 4 rules will save you from most of those blowups. Risk 1% per trade, maximum. Stop loss set before entry and never moved wider. No trading the first hour of London Open until you've done it 50 times on demo because the volatility around 8 a.m. GMT is brutal. And no revenge trades. After a loss, your next trade is your normal setup, normal size, normal time, not double size to get the loss back. Break any of those 4 in your first year and you start over, from scratch. Last piece, the broker. You want a Tier 1 regulator on your account. FCA in the UK, SISEC in the EU, BaFin in Germany, ASIC in Australia, NFA and CFTC in the US. If your broker is regulated somewhere you've never heard of, that's not a regulator, that's a postbox. Before you deposit a single euro, do 3 things. Read the risk disclosure cover to cover. Verify the registration on the regulator's own website, not the broker's. And deposit only what you are psychologically prepared to lose completely, because you might. So, verdict. Forex is not a side income opportunity. It's not a path to 6 figures. It is a learnable skill with a brutally high failure rate driven mostly by the math beginners refuse to do. Start with 500 to 2,000 euros at a Tier 1 regulated broker. Trade eur-USD only. Risk 1%. Set your stop before you enter. Journal every trade, and don't judge anything for 6 months. Daily P&L is noise, monthly is still noise, quarterly is where signal starts. Do that, and you won't be guaranteed to win, but you'll have a fair shot, which in this market is the most honest promise anyone can make.
eur-USD only, 1% risk, 6-month horizon. Check the description for the full breakdown.